Pensions and ISAs are two powerful tax-efficient vehicles for you as a saver that can be used to help boost your savings pot. However, the key question is which is more efficient from a tax perspective, and how do you make an informed decision as to which you should utilise? In this video, I will cover a refresher on what is a pension, the most common types of pension schemes, the tax benefits of a pension, what is an ISA, tax benefits of an ISA, and which is better, a pension or ISA for tax efficiency. Before I get into today's video, be sure to visit our Accounting and Tax Academy membership area where you can get access to exclusive in-depth courses, templates, calculators, and a members Q&A section where you can get your specific accounting and tax questions answered by a qualified accountant or chartered tax advisor. Pensions are designed specifically to help you as an individual save for your retirement. You are able to save a relatively small amount of your income on a regular basis across your working lifetime, and your contributions receive generous tax relief. Once in the pension plan, your money is then invested in different assets, and that's dependent on the risk profile of the plan, with the aim of increasing the overall value of your savings. And then when you eventually reach retirement age, the money can be distributed to you in different ways to fund your retirement. Money saved within a pension pot cannot usually be accessed until you, the individual, is at least 55 years old, although this varies by scheme. We've done a very useful video on 3 key ways you can access your pension pot in a tax-efficient way by clicking on the link in the description box below. There are different types of pension schemes available to you, and which one you would pay into will really depend on your personal circumstances. The majority of the working or self-employed population will be a member of one of the following. Number 1 is an occupational pension established by an employer to provide benefits to employees. An occupational pension scheme could be a defined benefit scheme where the benefit you receive on retirement is based on your earnings and length of service with your employer, sometimes referred to as a final salary scheme. Alternatively, it could be a defined contribution scheme where the benefit you receive on retirement depends only on the value of the pension pot at the retirement date. Number 2 is a personal pension. This type of pension is usually for individuals who are not in employment. So if you are self-employed, or if you are employed but want to save outside of your employment, a personal pension plan will be a defined contribution scheme. So the benefit on retirement is based on the value of the scheme at the date of your retirement. You as an individual may also benefit from the state pension, which is currently set at £179.60 per week in the 21-22 tax year, and contributions are made via national insurance. You must have 35 qualifying years of contributions as things currently stand on your record to be entitled to the full state pension when you reach the state retirement age. The state pension age is dependent on a few factors, and you can quickly check your specific state retirement age by following the link in the description box below to the government state pension age checker. Quite often, a state pension alone isn't usually considered sufficient to fund an average lifestyle in retirement here in the UK, so it is heavily encouraged that you plan for retirement by taking out an additional pension or saving money elsewhere. By saving your money in a registered pension, that is one that is registered with HMRC, you will enjoy a number of generous tax benefits that will give your savings a boost. Those benefits include, but are not limited to, tax relief on the individual contributions. HMRC are often able to give tax relief on contributions made by you, the individual, usually up to the equivalent of 100% of your net relevant earnings, or £3,600, whichever is higher. Tax relief is usually given at the individual's marginal rate of tax, so if you are a higher or additional rate taxpayer, then you can benefit from 40 or 45% tax relief. This means that an additional rate taxpayer who wants to add £100 to their pension pot can often do so by contributing as little as £55. Those of you who make large contributions should be cautious of the annual allowance charge, which can result in an additional charge to the taxpayer, that's you, but this only usually applies where contributions exceed £40,000 in a tax year. Investments within the pension are able to grow tax-free. Any return that investments within the pension generate are usually free from capital gains and income tax. A tax-free lump sum. When withdrawing a pension, a 25% lump sum can be withdrawn tax-free, whilst the remainder will be subject to the usual income tax rules, which may or may not result in tax being payable depending on your personal circumstances. And finally, it is not included as part of your estate for IHT, that is inheritance tax. The value of your pension scheme is not part of this at all. An individual savings account is another tax-efficient vehicle to house your savings in. The ISA is not specifically designed for retirement savings, but it is suitable for this particular job, if planned and executed properly. The ISA offers you, the saver, more flexibility and easier access to your money, as some types of ISA will allow you to access your money with little or no notice. You can choose between different types of ISA to suit your needs and risk appetite. As an individual, you have an ISA allowance of £20,000 per tax year. As of the current 21-22 tax year, you can save this amount in one type of ISA or spread it across a number of different ISA types, but you as an individual cannot pay money into two ISAs of the same type within the same tax year. There are a number of different types of ISAs available in the current market to suit the different needs of you, the saver. These include a cash ISA, similar to a savings account, except any interest received is free from tax. Due to record low interest rates, this type of ISA is currently unpopular with savers, but as savings rates increase, it becomes a more attractive option, as it is extremely low risk. Stocks and shares ISA. Savings are invested into listed stocks and shares. Any income generated by those investments is free of tax. This includes dividend income, which usually falls under income tax rules, and any capital gains, which falls under the capital gains tax rules. Innovative Finance ISA involves your savings being used to provide peer-to-peer loans. This is a less well-known ISA and as a result is generally less popular at the moment. And a lifetime ISA. Savings could be in the form of cash or stocks and shares, or a combination of the two. The lifetime ISA shares a similarity with a pension in that contributions can benefit from tax relief. However, you as an individual can contribute a maximum of £4,000 per tax year into a lifetime ISA, and tax relief is only at the basic income tax rate of 20%, which means a maximum of £1,000 tax relief can be achieved in any tax year. The lifetime ISA offers less flexibility, as to keep hold of the tax relief savings must remain in the ISA until you reach the age of 60. The £4,000 lifetime ISA allowance is considered part of the overall £20,000 allowance. So once £4,000 has been paid into a lifetime ISA, the individual will have £16,000 allowance remaining for all other ISA types. Just like pensions, any savings held within an ISA can also enjoy a number of tax benefits, but they differ slightly from saving within a pension. The key tax benefits include tax relief on some contributions. Only savings in a lifetime ISA attract tax relief on the individual's contributions. Contributions to this type of ISA are capped at £4,000 per tax year, and tax relief is given at the basic rate of tax only. Investments held within an ISA are able to grow tax-free, and in returns that investments within the ISA generate are free from capital gains and income tax. The treatment is identical for a pension or ISAs. Tax-free withdrawal. 100% of savings held in an ISA can be withdrawn tax-free. There is no cap on how large an ISA can grow and how much can be withdrawn, although savers should be aware that an early withdrawals, i.e. before 60 years of age from a lifetime ISA, will result in a 25% charge, which is HMRC recovering the tax relief they originally gave you. ISA balances can pass to spouses or civil partners. The value of an ISA is considered part of an individual's estate for inheritance tax purposes, but if passed to a spouse or civil partner on death, the spouse or civil partner will benefit from a one-off increase in their ISA allowance equivalent to the value of the inherited ISA. This means that not only do you inherit the ISA, but also the ISA's tax-free status. So this leads us on to which is better, including which is more tax efficient, an ISA or a pension. When trying to decide between a pension or an ISA, it's important that rather looking for an outright winner, you should be looking at which options best suit your individual circumstances and your requirements. Amongst other things, you should consider: how long are you happy to tie up your money for? A pension is typically a longer term commitment. What is the reason you are saving? For example, a house, a car, retirement, or just for a rainy day. An ISA is usually more suitable if you are not saving for retirement. Are you already contributing to a pension or ISA? You should be cautious of the annual and lifetime allowances. So here are 3 simple advantages of each vehicle. Pensions provide generous tax relief on your contributions, where ISAs generally do not, aside from the lifetime ISA. Pensions provide a 25% tax-free lump sum upon retirement, and pensions are far more powerful for higher rate taxpayers, that is 40% income tax rate payers. ISAs have no tax upon withdrawal of your money, whereas pensions do. ISAs offer better protection from politicians. Yes, politicians. They have a tendency to tamper with pension rates, allowances and rules, often changing the goalposts, particularly the retirement age when you can access your pension. With ISAs, you get tax-free withdrawals, whether now or in 20 years' time, regardless of the political party in power. For ISAs, you don't need earnings in order to save them. You can put up to £20,000 per annum into an ISA with no earnings, but for pension contributions, you need to be earning an income. The final point to consider is that it does not have to be a question of pensions or ISA. There is nothing stopping you from tactically utilising both vehicles and enjoying the combined benefits, but this should be done with due thought and planning first. If you want to learn more and go in depth about the pros and cons of pensions versus ISAs, including some common scenario case studies with numbers, covering directors, the self-employed, family planning, and non-tax benefits of each, and even more than this, then head on to our Accounting and Tax Academy membership area, where we have produced an in-depth course on all of this. This is Tony Dangel for the Accounting and Tax Academy, and as always, thanks for tuning in.